Hello, I'm Darius from Fund Caliber, and I'm delighted to be joined by Paul Jourdan, who is co-manager of the elite-rated TB Amati UK Smaller Companies Fund. Paul, how are you?
Very good, thank you. Great to be with you. Thanks for having me on.
So look, I've long since been a fan of smaller companies in most geographic regions, if I'm honest, but I thought maybe it'd be a nice introduction as to why you believe, having run smaller companies, funds, of VCTs for many years, why do you think smaller companies tend to outperform large companies over most long time periods?
Yeah, I mean, the very simple answer to that is that it's really about the law of small numbers in a sense. So share prices over long periods of time tend to track EPS growth, and that's earnings per share. So the amount that companies can earn for every share they've issued. And if that goes up, then the share prices tend to follow at some point. And as for a small business to do that, it's a lot more straightforward. If they latch onto a good business proposition and a good idea, and there's good barriers to entry and good management and all of that, they can get more EPS growth. And I think that's the real driver of it. And it's now quite a well-researched phenomenon. I should say, I don't want to talk against my own book, but there's some authors the authors of the study on the smaller companies effect, they called it, wrote this great analysis of why small companies outperform in the late 80s, only to be followed by about 10 years when they didn't outperform. So there are exceptions to the rule, but over the 55 years or longer that they've been studying this, there is a very strong smaller companies effect, and that's pretty well attested now.
Yeah. So let's delve into the fund then, shall we? I had a little look at your last fact sheet, which talks about revenue and the geographical split of revenue. I think historically we know the UK large cap index is heavily dominated by overseas earnings, but you've got some good overseas earnings as well. Is that something that's new or always been a strong theme within the fund? Tell us about that.
Yeah, it's not new to us. I mean, it's when we started Amati Global Investors back in 2010, we were a UK small cap fund manager only. We do a few more things than that now, but the reason we put global in the title is because we manage a fund that invests in the small companies listed in London, but we do so with quite a global mindset, and we've always done that, and it's in our name. And so, we've tended to have slightly more global earnings than our sort of benchmark would do. It's about 43% at the moment is UK earnings, if you analyse the revenues of the companies we own in the fund, and the rest is distributed across the globe, Europe and America and rest of the world, fairly evenly. And I think that just reflects our approach to managing the fund.
Another interesting theme that I see you have a couple of stocks in is oil and gas and the mining sectors. Is that a direct play on strong energy prices, or is this to do with sort of the energy transition theme that's quite common in the markets at the moment?
Yeah, I mean, to take those two things separately. So in terms of mining, I'd say I'm definitely an advocate for investing in mining. I know that the mining sector has many adversaries and people who would rather we didn't invest in it. For me, that's an untenable position, really. We couldn't achieve any of our objectives globally or industrially. Climate change would be impossible to change without a great deal of natural resources. Yeah. So we don't have vast numbers of investments in mining. We do have a separate mining fund that does that, but we have an investment in a copper miner in Spain called Atalaya. And one of the great things about having a mining team now on board in Amati is that I've got some specialists who can really check out the deposit. They've been to visit it. We feel we know that in quite a lot of detail. And it's the second largest position in the small companies fund. And it's done very well on the back of exceptionally strong copper prices, which look like they're here to stay for quite a while longer if we're going to do any kind of energy transition. The oil and gas sector is a bit more complex. And last year, it became a bit of a pariah sector. And fund managers like us were under, I'd say, really quite great pressure not to have anything to do with it. And we've kept a toe in the water with oil and gas. And we've done it actually because I think partly because I thought they were going to be very good investments. So, clearly, if we didn't think they were good investments, we would sell them. But also, I think it's actually irresponsible to sell out of the sector. And I've maybe been a bit of a lone voice in arguing that. But, we are still almost completely dependent as an industrialized nation on oil and gas supply. as we found to our cost over the summer. And maybe this is an easier point to make now, but 6 months ago, this was quite a lonely thing to be saying, that we really need oil and gas supply. Otherwise, we're looking at an economic catastrophe. And so I felt actually, contrary to some of the more popular voices around, the responsible thing to do is to invest in oil and gas, because without that investment, without ongoing investment, we're going to have a vast range of problems and much more than people really understand, I think. Almost everything we touch and do in our lives is powered by oil and gas at the moment. The way to move on from oil and gas is not to cut supply, it's to change use and to reduce demand. And until we've reduced demand, it's a hopeless game to try and cut supply.
Yeah, and there's, I suppose, a medium-term move to renewable energies, but it doesn't happen overnight, does it?
It doesn't. And at the same time as we're trying to keep some investment in oil and gas, we're also investing in hopefully some of the technologies which will enable us to change the demand structure. And that those are the two prongs, if you like, of our investment approach with energy transition.
And you touched in that last answer then on your more recent fund launch from last year, your strategic metals fund. I know these were a couple of fund managers that you knew from previous, and you brought them in to launch this fund into that sort of energy transition theme for the years. And you mentioned Atalaya mining. What else are they bringing to you on the small companies fund? What other insights are they bringing?
Oh, I mean, incredible insights, really, just in terms of the knowledge, a sort of detailed knowledge of how the various metals markets are operating and moving. Some very informed opinion about the demand structure in those different markets. And clearly, most of what they invest in is not in the UK market. So, but there are some stocks that we look at together, and it's hugely useful for me to have their specialty knowledge to be able to bring to bear on those companies.
Yeah. So, given that it's the most mentioned word, I think, in investments at the moment, but the I word, inflation. What's your views on inflation? How do you see that impacting smaller companies? I'm not asking you to make a big economic prediction about transitory or when it may peak, but high inflation, rising interest rates, what does that mean for you?
Yes, I think we were expecting inflation to be strong, and I think I've listened to lots of economists speak about inflation, and the ones I found most persuasive are really the old school monetarist economists who said if you increase money supply way above its normal rate, you will one day get inflation. And it's a sort of very well tested theory. It's discredited. It's not given credit by most sort of modern inverted commas economists. The central banks are completely ignoring it and therefore making lots of policy mistakes. And those policy mistakes are just going to drive inflation higher. And so I think we need a bit of sort of monetarist reality to seep into central banks. Money supply just grew at the most phenomenal rate in 2020. We haven't seen anything like that since the Second World War. So you could say, I think people looking back and say, well, of course that led to high inflation. And so we've reawoken this thing that we sort of thought was dead and buried and forgotten about. And lots of economists still think it's going to just go back to sleep. Maybe it will, and I'm not the massive predictor of the future. I suspect right now it's going to remain a problem for longer than it's comfortable. And the worst case scenario is it gets embedded, and we all start to expect 5%, 6%, 7% inflation every year, and that'll completely change the psychology of the economy. The dilemmas it faces for investors are, we're in a less comfortable sort of scenario than we were. The stock market got a bit overrated last year. It's clearly sold off heavily at the beginning of this year, and it's raised many questions. It's a bit hard to disentangle how much of that sell-off is really coming from the possible war in the Ukraine. And I think certainly a big chunk of it is, but some of it is also because of high inflation leading to higher rates, leading to a slowdown in the economy, possibly next year. And so there are those twin concerns rising themselves. And so what do you do as an investor? Well, the problem with high inflation is that cash in a world of negative real interest rates, which is what we have, just extraordinary negative real rates. Yeah. Cash is not a great protection. But so there's this dilemma of, So I think what we're looking for are investments that have pricing power, that can keep up with inflation in the way that their earnings are going to grow. And those kinds of investments should prove better than holding cash, because with cash you're kind of guaranteed to lose money in real terms. We're looking for investments that can make real returns, and I think that's the kind of core job of a fund manager, is to make real returns over time. So we're kind of going back to some basics here, really, and but the inflation, the advent of this high level inflation changes the picture quite a lot, and we're having to dig back in our memories to sort of say, well, what happens with high inflation to this industry or to that industry? And we've been going through that exercise for quite a few months now.
Well, there's definitely a disconnect where inflation is between 5 and 7%. Cash rates globally are between 0 and 1%. Yeah. That does lead to a quite large negative real rate on cash. So look, let's close now by touching on one or two names in the fund. A couple of names that jumped out to me: One Savings Bank and Indivior. Would you like to talk briefly on one or both of those?
Yeah, One Savings Bank is a specialist lending bank in the UK. Its main specialty is funding buy-to-let mortgages for professional landlords. So as in landlords who have more than 10 properties. They're quite complex loans to make. They require all kinds of bespoke underwriting. And One Savings Bank and Paragon Bank are the two major specialist lenders in that segment. And we just see that as a very attractive place to be. The net interest margin, which is how you measure a sort of bank's earnings, the difference between how much they pay for their deposits and how much they can charge on their borrowers, is 2.5% to 3%, that kind of range. That's a long way above what the big banks will be able to make on domestic mortgages. And so it's a very high returning bank. Its return on equity has been pretty consistently over 20%. And those are returns that the big banks would dream of. And yet it's also been growing over the last 5 years. And the market, in its wisdom, rates it on a very low earnings multiple, low price to book. It's kind of cheap on most measures. It has a good yield. And we think actually this is a very favourable environment for them. And so that's a big position in the fund, and one that we pretty high conviction over. Indivior, this is a company that spun out of Reckitt Benckiser, and it's a pharmaceutical business, and it operates in the US, and its whole focus is really on the providing treatments for opioid addiction. And it does have another product too for schizophrenia, but its main focus is opioid addiction. It was the market leader with this what they call Suboxone film, which was a film that you put under your tongue, and that would basically provide a replacement opioid that would then block all the receptors in your brain. So if you then take the drug, it has no effect. The problem with that is that when doctors prescribed it, patients, when they wanted to take the real thing, would just stop taking it and start taking the drug again. So in order to increase compliance, and compliance was pretty low with that film, they made a long-acting version where you can have this injection, which is then a once-a-month treatment. And when the doctor has prescribed this and the patient's taken it, then for a whole month, they're going to get this drug replacement. And that means that compliance then can't falter during that period. And so the company's been in this transition between the old drug and the new. The new drug has a whole range of has new patent protections. The old film had come off patent and there's lots of generic versions of it now. So it's a slightly painful transition to make, but the company's now out the other side of it. The new product is selling very well. It's a very important treatment in the US. This is a huge problem in many countries, but it's particularly acute in the US. So it's a company that we think is doing actually great work, and it's got an important new product. It's non-cyclical. It shouldn't be affected by any kind of slowdown in the economy, and we like its prospects. So that's a newish holding in the fund.
Paul, thank you very much for taking us through smaller companies, sectors, geographies, earnings, and a couple of lovely stock examples to finish. Thank you very much.
Great pleasure. Thank you.
If you'd like more information on the elite-rated TB Amati UK Smaller Companies Fund, please do visit fundcalibre.com.